Welcome to FM with Sir Evans. In today's session, we will discuss the third competency in the syllabus of ICAG Paper 2.4, Financial Management. Let's get started. Money is not free to borrow. Interest is the extra amount an investor will receive after investing a certain sum at a certain rate for a certain time. It is also the additional money that is paid by the borrower to the lender for the use of money loaned to him. One form of such interest is simple interest. This is where the annual interest is a fixed percentage of the original amount borrowed or invested. To find our simple interest, S is equal to P into bracket 1 plus Rn, where S stands for the amount to be paid or received at the period end. I is the interest charge, P is the principal, R is the period interest rate, and N is the number of outstanding periods. I, which is the interest for the whole period, is also equal to PRN. So as I mentioned, P is the principal, which is the amount borrowed or invested. So let's take an example. A person borrows 10,000 at 10% simple interest for 5 years. Find the amount paid at period end and the annual interest charge. So P here is the 10,000, R is the 10%, and N, the outstanding period, is the 5 years. So when you put it in the formula, you should get amount to be paid to be 15,000. Amount to be paid at period and 15,000. The total interest throughout the whole 5 years is equal to P, which is 10,000, R 10% times 5. And that will give us 5,000. However, there could be interest which isn't for the whole year, but then it's less than a year. The period is less than a year. So interest rates are usually annual interest rate. This means that they are the rate for borrowing or investing for a whole year. However, where a shorter period is required, then the annual simple interest is prorated to find the rate that relates to the shorter period. So we have a tweak in the formula. So S, which is the amount which have been paid or will be received at the period end, is equal to P into brackets 1 plus R over M times NM. And then I, the total interest for the whole period, is equal to P times R over M times NM. So M that we've introduced is the number of parts in the year. So we'll take an example. A person borrows 10,000 at 10% simple interest for 8 months. So we have a monthly situation here, and there are 12 months in a year. 12 months in a year, meaning our M, which we have introduced, is going to be 12. So when you put it in the formula, you'll be getting P to be 10,000, R to be 10%, and our M is going to be 12, and our N will be 8 months. So when you put that in the formula, you'll be getting 10,667 to be the amount to be paid at the end of the whole loan period. And then if you want to find the total interest for the whole period, it's going to be 10,000 times the 10% over 12 times 8. And that will give us 667. Okay, so compound interest, unlike simple interest, compound interest is where the annual interest is based on the amount borrowed plus the interest accrued to date. So the interest accrued to date increases the amount in the account, and then interest is charged on that new amount. So annual interest is the amount borrowed plus interest accrued to date. So with this one, Sn is equal to SO 1 plus R raised to the power n, where Sn stands for the final cash flow at the end of the loan. SO is the initial investment. R is the period interest rate. N is the number of periods. So we can say 1 plus R raised to the power n is the compounding factor. So look at example 3. We are to find the final cash flow for 10,000 cedis, which is borrowed at compounding rate of 10% to be repaid after 3 years. So when we are putting this in the formula, our SO is 10,000, our R is 10% to be repaid after 3 years. So it will give us an SN of 13,310. Now, the rate for a shorter period is calculated It's like the simple interest. We could have instances where the rate isn't for a whole year. So a rate for a shorter period is calculated by compounding by parts or continuous compounding. So look at the compounding by parts. So as I mentioned, the interest is a non-annual period. So our Sn is equal to SO 1 plus R over M times N times N raised to the power N times M. So you notice that whenever we are introducing the M, it is dividing the R and it is multiplying the N. So we'll take an example. A bank lends 100,000 at an annual interest rate of 12.55%. Interest is compounded on a quarterly basis and duration of the loan is 3 years. How much will the client pay at the end of the period? So for this question, it's compounding on a quarterly basis, meaning the number of parts that this will happen in the year is going to be 4, because we have 4 quarters in the whole year. So when we put this in the formula, SO is 100,000, R is 12.55%, M is 4. So 12.55% over 4 raised to the power, we have 3 years. So 3 times 4. And that will give us S of 144,877. So if a loan is compounded continuously, now I mentioned that the other instance of finding a non-annual rate is the continuous compounding. So if a loan is compounded continuously, then the equivalent period rate must be calculated. So what we are saying is that where you want to, the thing is not compounding for a whole year, then we need to find a period rate, which would be not for the whole year, but for that specific period. So interest for a long period is converted to a shorter period using the period rate formula. So the period rate is equal to 1 plus R raised to the power 1 over N minus 1. So where you have an annual rate and you are converting it to a lesser compounding period, then you use the period rate. So our R, as we know, is the known annual interest rate for the known period. N is the number of times that the unknown fits into the known period, recognized as a fraction. So example, if annual interest rate is 10%, what are the following period rates? A 6-monthly interest rate and 3-monthly interest rate. So we'll take the first one. So if it's a 6-monthly interest rate, what we are saying is this 10%, we are bringing it down to a 6-monthly, and that will happen twice in a year. So it's going to be 1 plus the 10% raised to the power 1 over 2 minus 1. And that will give us 4.9%. And if it's a 3-monthly period rate, there are 4 3-monthly periods in the year. There are 4 of such. So it's going to be 1 plus the 10% raised to the power 1 over 4 minus 1. And that will give us 2.41%, which means that where you have a question with a compounding period less than a year, use the period rate to convert that annual rate into the specific period rate, and then you input it into the formula. Okay, now we can also gross back. That is where we are giving a rate which isn't annual, and we want to find the annual of such a rate. So we use a compounding formula, which is 1 plus R raised to the power N minus 1. So for this one, interest for a shorter period will be easily grossed up for a longer period using the compounding factor. So we'll take an example. If the 3-monthly interest rate is 2.41%, what is the annual rate? Meaning the 2.41% isn't an annual rate, but it's a 3-monthly interest rate. Now 3-monthly happens 4 times in a year. So we are having 1 plus 2.41% raised to the power 4 minus 1, and that will give us 10%. So always note that the rate of interest R must be consistent with the length of period N. If the rate is a 3-monthly rate, then our N is supposed to be in such format. It should be in multiples of 3 monthly. If the R is annual, then our N, the length of period, must also be in an annual position. Okay, so we'll take one full question. A bank lends 10,000 at an annual interest rate of 12.55%, with interest to be charged to the borrower's account on a quarterly basis. That's every 3 months. The duration of the loan is 3 years. We should find the final payment. So here, the interest rate is annual, 12.55%. And then the compounding is on a quarterly basis, and our duration of loan is 3 years. So our N is annual, our R is annual. But then we are supposed to convert both to a quarterly, that's 3 months. And for a quarterly basis, it happens 4 times in a year, meaning that our interest, which is the R, is going to be 12.55% divided by 4, and our N, which is 3 years, are going to multiply it by 4. Better still, you could use the period rate formula, that's the 1 plus R raised to the power 1 over N minus 1, to find this period, this 12.55%, convert it into a quarterly one. So 1 plus 12.55% raised to the power 1 over 4 minus 1 will give us 3%, which we would use. So when you do that, you have your 3 monthly interest rate to now be 3%. Our N is going to be 3 years plus times 4, which is 12. And as I mentioned, the N must be the same frequency as the period, the interest rate. And that will give us a final payment of 142,576. Okay. So with simple and compounding interest, a one-time inflow or outflow is received or paid. However, there could be instances where, say, there is 30,000 which is invested every year for 5 years, or 500 cedis which is invested every month for 24 months. So this situation is what we call annuity. It's a series of regular periodic payments of an equal amount. Now, to find annuity, we have 2 instances. We have the ordinary annuity, which is where the payments or receipts are in arrears. That is, they are paid at the end of each payment period. And that's the formula. We have X into bracket 1 plus R raised to the power N minus 1 all over R. And we have the annuity due. This is where the payments or receipts are in advance. That is at the beginning of each payment period. So all payments, whether receipts or payments, are all under annuity due. That are under annuity due are 1 year earlier than those under ordinary annuity. So you realize that for annuity due, we have 1 plus R, which is being introduced at the end of the formula. So our SN is the final cash flow at the end of the loan. Our X is the annual investment. Our R is the period interest rate, and our N is the number of periods. Okay, so we'll look at an example. Example 6. A savings scheme involves investing 100,000 per annum for 4 years. If interest rate is 10%, what is the sum to be received at the end of the 4 years where payment is in arrears, payment is in advance? So with this question, our SN becomes our X, which is the amount, the annual investment to be made, or the money to be paid for each compounding period, for each period is 100,000. And then our R, as we see in the question, is 10%. Our number of period is 4 years. So when you put that in the formula, for those which are paid in arrears, that's ordinary annuity, we have 464,100. And if it is paid in annuity due, that's in advance, we have 510,510. Okay, so we have instances where we are setting aside a fixed sum of money at regular intervals to achieve a specific sum at some future point in time. So we may have an investment target which we want to meet after a number of years. So we would be saving a fixed amount of money till we get to that point. So now that's sinking fund. So it involves fixed sum of money at regular intervals for a future goal. So we will be required to find a fixed annual amount which is necessary. So we use the same annuity formula which we looked at, considering if it is in advance or in arrears, and we make X the subject. So we'll take an example. A company will have to pay 5 million to replace a machine in 5 years. So the company wishes to save up to fund the new machine by making a series of equal payments into an account which pays interest of 8%. The payments are to be made at the end of the year. So being made at the end of the year means it's an ordinary annuity. And then the target is 5 million. Number of period, 5 years. Rate is 8%. So what's the fixed amount? So we use the same annuity formula, but this, we start from 5 million is equal to X raised into brackets 1 plus our R, which is 8%, raised to the power 5, minus 1 all over 0.08. And that will give us an annual payment of 852,878. Okay, second example, a grandparent wishes to save money to help pay for his newborn granddaughter's wedding. He intends to save 5,000 every 6 months for 18 years immediately. So immediately there means that it's a payment in advance. That's annuity due. The account pays interest of 6%, compounding semi-annually every 6 months. What will be the balance on the account at the end of 18 years? So we can see here that in this scenario, we've been given the frequent payment, and that is the 5,000. And then it's going to be paid every 6 months for 18 years. So there need to be some conversion here. So our 6% is an annual one, but we need to convert it into a semi-annual compounding rate. So either you do 6% divided by 2, or you use the period rate formula, which is a 1 plus r raised to the power 1 over n minus 1. So when you put that into the formula, you are going to get 5,000 to be the frequent amount, 1 plus 0.06 divided by 2. Then our n, which is 18 years, needs to be converted as well. It's going to be 18 times 2. And that's what we'll put in the formula. All of this minus 1 all over 0.06 over 2. And that will give us 325,823 being the balance on the account at the end of that 18 years. A third question, a business wishes to start a sinking fund to meet a future debt repayment of 100 million due in 10 years. What fixed amount must be invested every 6 months if the annual interest rate is 10%, compounding semi-annually, if the first payment is to be made in 6 months? So this is an ordinary annuity. Our amount which we are expecting at the end of the whole period is 100 million. So what we'll be looking for is the annual amount, the fixed amount to be invested every 6 months. Our 10% needs to be converted into a semi-annual. So 10% divided by 2. Our N, which is the 10 years, need to also be converted into a semi-annual period. So 10 times 2. And that will give us 3,024,803. Okay, discounting estimates the present day equivalence. So that's the present value. If you are discounting something, it means that you are looking at the present day equivalent of a future cash flow at a specified time in the future at a given rate of interest. So an amount expected at a specified time in the future is multiplied by a discount factor to give the present value of that amount at a given rate. So discount factor is the inverse, is the reverse of a compounding factor for the same period and interest rate. We have discount tables which can help with that. So discount factor is equal to 1 over 1 plus r raised to the power n. You realize that then PV is equal to, so as I mentioned, discounting helps us find the present value, which is PV. So PV is equal to FV, which is the future value, multiplied by 1 over 1 plus r raised to the power n. And if you remember the compounding, when we are looking at compounding interest, we said our amount expected at the end is equal to the present value multiplied by 1 plus r raised to the power n. So if you are not compounding and you find you want a reverse of that, then you are discounting. So example, a person expects to receive 13,310 in 3 years. If the person faces an interest rate of 10%, what is the present value of this amount? So we use the PV formula where 13,310 is the future value, then our multiply by 1 over 1 plus r. R is 10%, n is 3 years. So we get a PV of 10,000. Example 11, an investor wants to make a return on his investment of at least 7% per year. He has been offered a chance to invest in a bond that will cost 200,000 and will pay 270,000 at the end of the 4 years. So you should find the amount he would have invested. So the amount to be received at the end of the period is 270,000. And then we have a rate of 7%, number of years, 4 years. When you do that, you get a PV of 206,010, meaning that this is what he should have paid, but he ended up paying only 200,000. Then it means he has benefited from, the investor will be willing to invest 206 and 10,000 to earn 270 after the 4 years. However, he's now investing 200,000, which indicates that the bond is providing him a premium, a return in excess of that 7% per year. So we have discounted cash flow technique, which is for evaluating proposed investments to decide whether they are financially worthwhile. So there are two methods of this discounted cash flow. We have the net present value method, and we have the internal rate of return method. So we'll start with the net present value method. So to calculate NPV, you first list all your cash flows that's going to arise, showing the initial investment, the future inflow, the future outflow, and any closing outflow. And you discount this using the discounting factor. That's the cost that the company has to pay for its capital as a discount rate. So you discount each of these cash flows, and then you find the net present value. Now, in making a decision where the NPV is positive, you accept. Where the NPV is negative, you reject. So take an example. We have a company considering whether to invest in a new item of equipment that costs $65,000 to make a new product. So that's an outflow. The product will have a 3-year life, and the cash profits over this period is $27,000, $31,000, and $15,000 for each of these years. Now, the NPV of the product, we should find the NPV using a discount rate of 8%. So as we mentioned, you need to list all cash flows. For year 0, the cash outflow is $65,000. Year 1, inflow $27,000. Year 2, inflow $31,000. Year 3, inflow $15,000. And then for each of these items, you need to discount them using the discount factor. So in year 0, it's going to be 1 over 1 plus R raised to the power 0. R here is 8%, and that's not going to give us 1. Now, year 1, the discount factor is 1 over 1 plus 0.08% raised to the power 1. And that will give us a discount factor for year 1. In year 2, the discount factor is 1 over 1 plus 8% raised to the power 2. And that will help us. At the end of the period, we are going to sum the present value of the outflow, the year 1 inflow, year 2 inflow, year 3 inflow, and that will give us an NPV of negative 1,515. So for this particular project, because it's giving us a negative, as we looked at earlier, the decision rule is not to accept this particular project. And example 3, a company is considering whether to invest in a new item of equipment costing $53,000 to make a new product. The product will have a 4-year life, and the estimated cash profit over the 4-year period are: year 1 is $17,000. You find this equivalent discount factor using 11%. Year 2, $25,000. 3, $16,000. 4, $12,000. And then the initial outflow is $53,000. So when you sum all their PVs, you should be getting 2,210. Now, this project looks attractive because it's giving us an NPV above 0. It's a positive NPV. So an annuity is a constant cash flow for a given number of time periods. So whenever we talk about annuity, we are looking at constant cash flow. So we have a discounting annuity. So what that does is that if you are going to invest a particular amount of money over a number of periods, how much are you going to make now? So unlike the previous one where we saw, the previous one looked at how much you are going to make in the future when you are contributing that frequent amount. But this is looking at the discounting annuity, is looking at how much you are going to make now. So a capital project might include estimated annual cash flows that are an annuity. Example, $30,000 each year for 3 years, $50,000 each month for 2 years. So an annuity factor for a number of period is the sum of the individual discount factors. So if you have an annuity factor, is the sum of all the individual annuity factors over that frequent payment period, and that will give us the discounting annuity factor. So the annuity factor here, which is the discounting annuity factor, is 1 minus 1 plus R raised to the power minus N over R. Or you could use 1 over R bracket open 1 minus 1 over R raised to the power N. So we have a question. A company is considering whether to invest in a project which would involve the purchase of a machinery with a life of 5 years. The machine would cost $556,000 and would have a net disposal value of $56,000 at the end of 5 years. So we can see that year 0, which is the initial year, there's an outflow of $556,000. We use the discounting factor for that, 1 over 1 plus 15% raised to the power 0. Now, it will also have a net disposal value of $56,000, which is an inflow at the end of year 5. That one too, we discount it, 1 over 1 plus 15% raised to the power 5. Now, the project will earn annual cash flows of $200,000. So over the 5 years, there's going to be inflow of $200,000. In the previous example, there were different inflows for different years. But this example, there is a frequent $200,000 which is being earned for each of the 5 years. So instead of finding discounting factor for each of them for the whole 5 years, then you will now use the annuity factor, annuity discounting factor. So this is fine. You can use the normal discounting factor if the periods are few, but you could have a frequent inflow of, let's say, 10 years. It could be ending for 10 years. You can do it for each of those 10 years. So far as it's frequent, you can use a discounting annual factor. The amount is constant. So we use the same formula for NPV. We need to list all our cash flows. We need to discount each of them. We find the NPV, and that should give us an NPV of 142,273. A company is considering whether to invest in a project which would involve the purchase of a machine with a life of 4 years. The machine will cost 1,616,000. That's the initial outflow, which is year 0, and net disposal of 301,000 at the end of year 4, which is we'll discount it at the end of year 4 using the 4th year discounting factor at a rate of 10%, and there is an annual cash flow of 500,000. So we apply the discounting annuity factor on this 500,000 over the 4 years. So the annuity factor will be 1 minus 1 plus 10% raised to the power minus 4 all over R. And we just multiply that annuity factor by the 500,000 to get the present value for those annual cash flows. We add that to the present value of the initial outflow and the present value of the disposal inflow, and that will give us an NPV of 174,519. Now, perpetuity. So the discounting for perpetuity, perpetuity is a constant annual cash flow forever or into a long term. So R is the cost of capital. So the perpetuity factor, let's say 2,000 in perpetuity at 8%. The perpetuity factor is 1 over 0.08. We multiply by that by the 2,000, and we are getting 25,000. Now we have some applications of annuity. So as we said, in finding the PV, then we multiply the constant cash flow by the discounting annuity factor. Then we can find the present value. So let's say we have example, a company is considering an investment of 70,000 in a project. The project life would be 5 years. What must be the minimum annual cash return from the project to earn a return of at least 9% per annum? So with this question, 70,000 is what you are going to pay now. So you use this PV is equal to the cash flow multiplied by the annuity factor. A is the annuity. Okay, so an annuity is multiplied by an annuity factor. An annuity being the frequent payment is multiplied by the annuity factor to give the present value of the annuity. If the present value is known, then it can be divided by the annuity factor to give the annual cash flow for a given period. So with this particular question, our PV is 70,000. What we are looking for is the annuity, the minimum annual cash return. Number of period is 5 years and then 9%. So we'll be getting 170,000 is equal to A is what we are looking for times 1 minus 1 plus the 9% raised to the power minus 5. Minus 5 being the number of years divided by the 9%. And that will give us 17,995. Now we can also apply this same annuity arithmetic for loan amortization schedules. So a company may be borrowing 1 million. This to be repaid by 5 equal annual payments at an interest rate of 8%. So you apply this in this same PV is equal to annuity times the discounting annuity factor, and you get an annuity of 250,438. Then you can build an amortization table, which will be the opening amount, and then you have the interest which you are supposed to pay, the frequent payments to be made, and the closing amount. That will help us in finding building the amortization table. Okay, so a person may save a constant annual amount to produce a required amount that at a specified point of time in the future. So we looked at discounting annuity where we have a frequent cash flow and we are looking for the present value of that particular frequent cash flow. Now, sinking fund is looking at we having that frequent cash flow, but what will be the future position of it? So it's either a present position, then you go for discounting annuity, or a future position, then you go for sinking fund. So the sinking fund factor, okay, or you can say the sinking fund annuity factor, which will help us find the future value of that frequent cash flow. Discounting annuity factor or present value annuity factor will help us find the present value of that constant cash flow. So those are two forms of annuity factors there. Now, this is the sinking fund factor. And then is 1 plus R is the power n minus 1 over R. And our n is the number of period, R is the interest rate. So our sinking fund factor will help us find the FV, the future value. So FV is equal to the A, the annuity, multiplied by that sinking fund factor. So as I mentioned, the annuity factor therefore comes in two forms. We have the discounting annuity factor, or the PV annuity factor, which is used to find the present value of the constant cash flow, and then the sinking fund factor, or the FV annuity factor, which is used to find the future value of constant cash flow. So for each question, we need to look at the question and ask ourselves, are we looking for a future value annuity, or we are looking for a present value annuity? If it's a future value annuity, then we use the sinking fund approach. If it is the present value annuity, then we use the discounting annuity factor. And where the question does not involve a constant annual cash flow, that's an annuity, then you are going by your simple FV or your simple PV formula. Okay, so this question says, a man wishes to invest equal annual amount. So that alone should let you know we are looking at an annuity position, so that it accumulates 5 million by the end of 10 years. So 5 million is being accumulated by the end of 10 years. So that's a future value. So use the sinking fund factor. The annual interest rate is 6%. What are the equal amount that he should set aside? So we use the FV annuity, which is FV is equal to 8 times 1 plus R is the power n minus 1 over R. And our annuity is 379344. Now, we mentioned that there are two forms of the discounting cash flow technique. We looked at NPV. Now, this is IRR. So IRR is another method of investment appraisal using a discounting cash flow. IRR is the discount rate that will give a net present value of 0. So it's the average annual investment return from the project. Now, the decision rule for IRR is to accept IRR when it is greater than or equal to the minimum acceptable rate of return. And we reject it where the IRR is lower than that minimum acceptable rate. So to estimate the IRR of an investment project, we first calculate the NPV of the project at the first discount rate. Then we calculate at a second discount rate. Now, to get a second discount rate, you will not often be given. Even sometimes you are not giving the first discount rate. So you must come up with a discount rate, but there are certain things that must guide you. So to get your second discount rate, if the first discount rate gave you an NPV which is positive, then you need to increase it to get your second discount rate. But if it gave you a negative, then you reduce it. Now, one of the NPV should be positive and the other should be negative. If both are positive or negative, it is fine, but IRR may be less reliable. Ideally, NPV should both be close to 0 for better accuracy in the estimate of IRR. So you would find that if you had to find your own first discount rate, then you could select, let's say, 4% or 7% or 8%, right? And when you are getting your first NPV, then based on the NPV you are getting, you either increase it or you reduce it. Then you use the interpolation formula, which is 8% being the first discount rate, bracket plus bracket OP, NPVA. NPVA is the NPV from the first discount rate. So 8% plus NPV of A over NPV of A minus NPV of B multiplied by B minus 8%. So this is an example. A project has year 0 initial outflow of 65,000. In year 1, 27,000, year 2, 31,000, year 3, 15,000. Now the project has an NPV of negative 1515 at a discount rate of 8%. So to find the IRR, the first discount rate used was 8%, and it was giving negative 1515. So to estimate the second discount rate, we need to reduce it. So let's say we'll use 4%, and then we also arrive at a particular NPV, and we input all of these into the IRR formula. So to use the IRR formula, we need the A%, which is 8%, then the NPV from the A. And we need the second B% and the NPV from the B. And that should give us an IRR of 6.6%. Now, these discounting cash flow techniques, that's NPV and IRR. Both techniques are based on cash flows rather than accounting profits, which are easier to manipulate and more difficult to interpret. Both techniques take account of the time value. Both techniques take account of all cash flows that are modeled and not just those in the payback period. So that's the characteristics of these two methods. Now, for individual projects, IRR methods will give the same decision as NPV, but for mutually exclusive projects, then we should use NPV instead of IRR. A mutually exclusive project is one where the acceptance of one project prevents us from engaging in the other. While individual project, we can do both at the same time. So for mutually exclusive, we need to use NPV to make the decision, since NPV is based on the actual cost of the capital. So we have some advantages of NPV and disadvantage, some advantages of IRR and disadvantages. I'll mention one of each. So for an advantage of NPV, it gives us an absolute value. It's a positive or a negative. But you realize that a disadvantage to IRR is that it gives us a relative measure, not an absolute value. A disadvantage of NPV is that it's not easily understood. And then also, you need to find the appropriate cost of capital. That rate, you need to find the appropriate cost of capital. It's difficult when you want to find that in real life. But then for IRR, it does not require you to estimate such. Now, there is discounting payback period, which also applies the discounting cash flow technique in its analysis. So it's calculated in the same way as the ordinary payback, with the exception that the cash flow of the project are converted to their present value. So the number of years before the cumulative NPV project reaches 0. So there is this formula where N1 stands for the last year of the negative cumulative, C1 stands for the last negative cumulative, P2 is the PV after the negative cumulative. So let's say this is our table for discounted cash flow. We have an initial outflow of 40,000 and a discount factor of 10%. So for the 0 year is going to be 1, and then 30,000 being the cash inflow for the first year, discount factor 0.909. When we do that, we get a PV of 27,270. So we build a cumulative NPV. So you realize that in year 1, year 0 is the outflow of 440,000. In year 1, we still have a negative of 12,730. Year 2 is giving us an annual cash flow of 120,000, and that will give us a cumulative of 86,390. So discounted cash flow is looking at that period. Discounted payback period is looking at that exact period where our cumulative NPV becomes 0. So we will apply the DPP formula, and then N1, which I said is the last year of the negative cumulative, is going to be year 1. So the last year of the cumulative being negative is year 1. And then our C1, which is the last negative cumulative, is 12,730. We divide that by the PV after the negative cumulative, that's the 99120. Multiply that by 12, you get 2.54. Now, this is in terms of months, 12 months. So 0.5 there stands for 6 months. So the discounted payback period for this particular project is 2 years, 6 months. It will take us 2 years, 6 months to recoup our initial 40,000 investments. Okay, so I would like to thank you very much for staying with me to this point. Kindly follow the link below to join the Telegram channel for the paper, where you can have access to the marking scheme, to all examples discussed in the session, and other relevant materials to aid your preparation. Thank you once again, and I'll see you in the next session.